You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
All right, everybody, welcome back to the Advisor's Option. This is indeed the program for busy financial advisors and busy asset managers who are looking for ways to implement options into their clients' portfolios and into their practices. My name is Mark Longo from the OptionsInsider.com, as well as from the ever-expanding, ever-exciting Options Insider Radio Network. If you haven't checked it out yet, listeners, I encourage you, if you're interested in a lot of the content we post up there on the mothership, the website, theoptionsinsider.com, particularly our unusual activity content, and we have a new show for you. It's called Options Oddities, and it's all about the unusual activity that we see and profile on the site every day. We record it live every day in the Swim Lessons chat room over there on the TD Ameritrade platform. So if you're a client over there, surf on over. You can join us live for the show every day. Ask your questions, ask your comments, give us your feedback. It's really fun stuff. Follow along with our charts and our graphs and our witty banter there on the old program. And you can, of course, find that wherever you find your favorite podcasts, including The Advisor's Option, on the OptionSider.com, the iTunes Store, Stitcher, Aha Mobile, wherever you like to find your programs. Or, of course, you can always just go to our mobile app, available for iOS, Android, and the Fire OS, and you can instantly stream all of your favorite episodes of The Advisor's Options there, as well as every other program on our network. And maybe you say, hey, I'm going to be on a plane for a little bit, I'm going to be in a commuter train for a while, I need to download these. Well, you can download any episode you want. It's all built into the app there. And while you're listening, you say, hey, I have a question about this topic, or I have a comment about this topic, or I'd like to know more about this, or I vehemently disagree with that. Let us know. It's all baked into the app right there. You can send us a Facebook question, a tweet, an email, even leave us a voicemail, all directly through the app. No shortage of ways for you guys to make your voices heard right here on the old Advisor's Options panel. Speaking of that panel, I am joined today by our usual cast of characters, plus a few tweaks. Starting off with the man who wins the pride of place for best office location. He is the co-founder of Swan Wealth Advisors, Mr. Randy Swan. Randy, welcome back to the program. How is the weather down there in scenic and sunny Puerto Rico?
The weather is typical. It's usually always 80 with a very low standard deviation.
Spoken like a true options trader there, sir.
Yep, I was actually in Durango last week with a firm-wide meeting, and it was amazing the different disparity in terms of climate it is from being at 7,000 feet above sea level to sea level. It's definitely truly amazing how far you can go in terms of the extremes of climates.
I'm sure you weren't too disappointed to get back to Puerto Rico after all was said and done.
You know what? I like the falls in Colorado, but I know that in about 3 or 4 months I'm going to be really happy about being in Puerto Rico at that point.
All right, and that laugh, listeners, means we are joined by the other compatriot there on the advisor squad for the Options Industry Council, Mr. Alan Grigoletto, the Director of Education over there at the OIC. Alan, welcome back to the show, sir. It has been too long.
Well, thanks, Mark. It's a pleasure to be back and great to be on with both Mike and Randy today.
Yes, and he mentioned Mike. We are joined by the other Mike this episode, holding down the RCM Wealth Advisors hot seat on the program. This episode, listeners, you may be familiar with him from his legion appearances on our Option Block program. He is deigning to join us today on the Advisors Option, provided the Skype gods continue to smile on him. He is Mr. Mike Tusaw from RCM Wealth Advisors. Mike, welcome back to the show, sir, or welcome to the show, I should say. It has been quite a while since you've been on.
It's good to be here, and just for the record, Mike Kavanaugh is the other Mike.
That's true. I never know which Mike is the other Mike. I'll let you guys sort it all out. Meanwhile, we're going to dive right on into our Options 101 segment.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, and welcome to our Options 101 segment. Like the name implies, this is the portion of the show where we break down some basic options concepts, some ideas, some strategies that you might find useful when incorporating options into your clients' portfolios. And we were talking about what to discuss on the show today, and we kept coming back to an interesting topic. We've been doing a lot more futures and futures options content on the Options Insider Radio Network. And whenever we talk to advisors and asset managers, they're always talking about diversification and finding exposure to a lot of alternative asset classes. And of course, the ways to do that are sometimes off-putting to them. There's diving into the big futures products, which are sometimes scary for a lot of advisors who aren't that familiar with trading derivatives, so that can be off-putting to a lot of them. Then there's also ETFs. ETFs have certainly exploded in a lot of regions, and a lot of advisors go to them, but there are indeed many inherent problems with going that route, particularly with trying to get exposure to some of the more esoteric commodities out there. And then, of course, we have options, which we like to talk about on this show quite a bit. And typically what we talk about on this show are equity and index products, and that is suited to a wide range of our listeners here. But every now and then, advisors like to spread their wings, pun intended. We'll talk about spreads with wings in a bit. And so we thought, what better thing to talk about today than how to use options and a lot of the strategies we've discussed on this show in the past to gain some exposure to some of these alternative asset classes you may be thinking about. Oil, very much in the news right now. Gold, very much in the news right now. Ags, corn and others, very much in the news right now. So there's a lot of other asset classes out there that are providing sources of volatility, potential sources of return, potential sources of diversification that a lot of advisors are simply not accessing. And so we thought we'd get into that today because it's an interesting topic and one that we haven't mined that much here really on this program. So let's start off with some basics and maybe we'll go from there. I think first off, it's worth mentioning that we've discussed a lot of strategies on this show in the past. All these strategies you'd like to talk about here, vertical spreads, iron condors, iron flies, collars, all these things we talked about before. It's nice to know you can do them all in futures options. They're not limited to Apple or Facebook or S&P or whatever the case may be. You can really do them in a broad variety of product categories. So that's the nice thing about options is they're very, very customizable to the underlying that you're trading. That said, if you're an advisor who's a little bit skittish about using futures, then maybe things like protective puts and covered calls are probably not going to be for you because you're going to have to require some sort of futures underlying in there to really hedge or generate some income off of. So maybe those aren't going to be the ones you're going to go for. But a lot of the other ones you talk about, verticals and others, are very much suitable to this style of trading. So maybe we'll start there. One of the more popular ones we know that a lot of advisors like to utilize is one we've talked about before on many of our other programs and indeed on this program. We typically refer to it as a stock replacement, but for this scenario, since we're talking mostly about futures and futures options, it'd be more of a futures, let's just call it a general underlying replacement strategy. Let's say you're looking at a precious metal or an agriculture or whatever the case may be, and you don't really want to have futures floating around in your account. Well, you can use options as a good surrogate for that. And one of the ways we've mentioned, like we said on the show before, is indeed the stock or the futures replacement strategy. And what that involves is essentially, instead of going out and, if you purchase stock, listeners, you have a 50% margin. So that's kind of the limit of your leverage there. If you purchase futures now, futures have a lot of advantages from a margin capability. They are a much more highly leveraged instrument. So the margin benefits of doing this strategy versus doing a typical stock replacement are fewer. But there are some other advantages, particularly, like I said, if you're skittish about futures for a variety of reasons. And this indeed involves purchasing typically a little bit longer term, maybe not a leap, but somewhere in probably the 6 month or beyond range from an options perspective. And usually looking at something a little bit more in the money range, because you want to have a little bit of meat on those bones. You want to have a little bit of delta and a little bit of intrinsic value to these options. So it typically involves purchasing an in-the-money option, and the advantages of that are clearly obvious. Of course, from a leverage capacity, you're able to buy this option on a leverage, not extend all the money you need to for the underlying. Less so from the future side, obviously, but still interesting benefit for a lot of people. And it also allows you to do all the different strategies that we've talked about many times on the show in the past, writing verticals against it and things like that, and all the benefits that come from using options if you're much more inclined to use those products. Mike, maybe we'll start with you here on this run. We've talked about using underlying replacement type strategies before, whether it's for an equity, whether it's for a futures option. Is this a strategy you employ a lot with a lot of your clients? And what are some of the use cases you would use something like this for when you're looking at perhaps gaining exposure to alternative type asset classes?
Yeah, to answer your question, I have probably about maybe 60 clients throughout the country, and I don't think I have any clients that don't have some type of option exposure in one way, shape, or form. Now, full disclosure, it doesn't mean that options are for everybody by any means, but typically with the type of client with which I'm working, there's usually, in my case, there's always going to be some type of option exposure, or otherwise they typically don't work with me in one way, shape, or form. So to answer the other question on it, what are some ways with which we do it? One of my favorites is that, let's say that we're looking for some type of stock exposure. And let's just assume that we want to have exposure to the S&P 500, and clients looking to invest $100,000. Client happens to have $90,000 in just a traditional non-qualified joint account and $10,000 in an IRA, or a Roth IRA for that matter. Well, what I like to do, if the client is looking to have stock market exposure with that, I like to take the $90,000 and put it into some type of tax-deferred or tax-free instrument, such as municipal bonds, depending on what state they live in, perhaps cash value life insurance, or maybe an annuity in one way, shape, or form. It just depends on the client. And then with the $10,000, what we'll do is we'll buy call options, and we'll monitor the risk with the call options. We'll sell premium against it, and we just have all sorts of fun on that. If you want to hear more details about what we do with the $10,000 that we're working to get the S&P exposure to the upside, I talk about that pretty much every day on our other show, The Option Block. Shameless plug, I know.
Hey, we're all about shameless plugs here on the network, sir, so I won't hold that against you. But you're right, there is a lot of, like we like to say here on the network, doing stuff involved in implementing that type of strategy. But it's also good, as you can see, listeners, just from talking about it here, the opportunity advantages you gain from doing things like this. It frees up capital, allows you to work in a different capacity, and allows you to put that capital to work on other trades or on doing other things for your clients than just tying it up in a very, let's say, large position of stock or something along those lines. So there are a lot of advantages to using the futures and indeed to using the options from an underlying perspective.
Yeah, and then just to kind of add to that, if you are a shameless long-term market bull, such as myself, then what that does is that gives you the ability to have stock market exposure within your IRA. So let's say that in theory, the stock market gains more than 3 to 5%, and you're going to have the leverage benefit of having your gains within an IRA. Now, of course, there's risk management that has to be involved with that. And like I said, with that, we talk about that on the other program a lot, so I don't want to talk about that too much here. But the benefits to that, I think, are tremendous, in that you can use that not only with options, but also with futures, if that's the instrument with which you choose to work.
Now, Randy, you guys obviously work with a lot of S&P type products, constructing overlays, writing calls, doing the put spreads to the downside, and all the fun stuff that goes into constructing those S&P 500 overlays. So a lot of your futures and futures options exposure is indeed in the financial realm as opposed to the commodity realm. But a lot of the same strategies and a lot of the same tools and methodologies still apply. So when you're looking at products to utilize when you're constructing these overlays, what are some of the criteria, what are some of the decision factors that you weigh when you're looking at, let's say, a futures option versus, let's say, something like a cash settle, like an SPX type product, versus what's probably very popular with a lot of our listeners, something like an ETF option like a SPY or something along those lines?
Well, first of all, I love the idea of incorporating different option strategies into a portfolio. I think it's natural progression to look beyond a normal S&P 500 or maybe a market index, financial index type situation. I mean, obviously, I think that the concepts that we've applied in the S&P 500 can be applied to whatever underlying. We always look at the option strategy itself as the engine, and the vehicle that you put that engine in can be varied. Fundamentally, as an advisor or as a money manager, we always look for advisors that are willing to, maybe expand their interest in the option strategies. As it relates to, I would just point out some of the good and bad things that I think with using futures. I think one of the disadvantages, obviously, is on the tax side, is that you may be forced to pay tax on a regular basis versus, something like the underlying ETF that you can hold indefinitely. I think those are some of the differentiating features. Clearly, I think finding managers that do strategies like this on other types of commodities, whether it's gold, oil, is something I think is definitely worth looking into.
Yeah, you're right. Futures have that same downside, for lack of a better word, that options do, and that they come with an expiration date, and a lot of advisors are perhaps not used to picking up an underlying that comes with an expiration date. They're used to buying, let's say, Apple stock, or they're used to buying Facebook, or whatever the case may be. And that stock, once you buy it, is yours. It sits in your portfolio. Unless it goes to zero, it's going to sit there in your portfolio. There's no expiration date on that, which is, again, why I think a lot of advisors are perhaps a little bit reticent to dive into the futures and futures option side of the pool, because it adds an underlying with an expiration date. It adds an option, of course, with an expiration date. So it comes with some double whammies that some of them may not want to deal with. Alan, you and Eric are crisscrossing the country on a regular basis, talking to a variety of different advisors and asset managers, talking about their uses of options, and, of course, issuing all those great studies that you guys have over there at the OIC about how advisors use options. Maybe we'll get into those in a little bit as well. What's your take on this product category with advisors? Is it starting to catch on? Are you starting to hear more inquiries and questions from advisors about, hey, what can I use options and futures for as a way to gain alternative exposure to some of these other asset classes? Or is it still something that's very nascent with the broad and vast majority of advisors?
I would say it's growing, Mark. Anytime you attend any conference that has advisors in attendance, there's always an alternative asset booth. And those alternative assets are, always visited by the advisors. They're always looking for something to put into a portfolio that, a client might want exposure to gold or silver or oil or any other diversification tool within the portfolio. So we do see that. Obviously, options are a great way to get exposure to those markets with limited risk. And I would say, since we can talk on a global experience. We're very equity-centric, I would say, in this country. But if you travel around the globe, as I do, and if you're in China or somewhere in Central Europe, you'll see that a lot of people do have a very strong interest in precious metals and in oil. And so if you're an advisor there in Europe or in China, you're definitely going to be dealing with questions about how to get exposure with limited risk on these products.
And we'll get into a few of those specific categories of futures and futures options in a second. And you're right, there is a lot of broad interest from a global perspective in those products, particularly in some of the commodities. And like I said, people looking for exposure to these alternative asset classes, you're probably going to be looking more on the long premium side from an option strategy position. You're not going to be coming out and really selling a lot of options in these products if you're looking to gain, let's say, exposure to a gold or a corn or something along those lines. You're probably going to be leaning towards the more long premium buying type of strategies. And we always recommend, of course, risk mitigated type strategies on this show. So things like vertical spreads and others where you have essentially spreading off a lot of your premium risk, remaining net unit neutral from an overall spread perspective. And those are the strategies that, of course, a lot of the advisors utilize when they do these. I mentioned, of course, the stock or the futures underlying replacement strategy. Vertical spreads are another way you can do it. You can make that in the money kind of underlying replacement type strategy and then write an out of the money call against it to get, again, mitigate some of your premium and outlay risk at the outset of the trade, and then also, of course, just to make it a little easier for you to execute those types of trades. Other spreads people like are, of course, some of the spreads with wings. Like I mentioned before, we talked about iron condors, iron butterflies, and things like that on the past. If you're curious about those strategies, go back. I encourage you to listen to our previous episodes in the archives where we dive into those types of strategies with a great amount of gusto, spend the whole hour on those. But everything we mentioned there applies here as well. It's just from a futures options perspective. The underlying is going to be different, but the actual strategy itself will implement and work the same with one caveat. And I want to mention this for pretty much all of the futures options products we're talking about today. On previous shows, we discussed volatility and volatility skew, and the volatility skew we usually refer to from an options context is what is referred to as investment skew. This essentially means that the level of implied volatility decreases as the underlying moves up above the at-the-money strike, so essentially the called portion of the option chain, that implied volatility level is going to be less. And as you move below that at-the-money strike into the put portion of the option chain, aka the put wing, that level of implied volatility is going to increase. And that's just a fundamental factor that a lot of people are used to in the marketplace because so many people are generally bullish the market, and that fear increases to the downside, and also the fundamental factors of buying puts to hedge, writing calls to generate income causes that level of skew. So people coming to options and then expanding to other products using options are used to that investment skew. Commodities and a lot of other futures options products don't have that skew. They trade entirely different skews. It could be, for example, a product that has a lot of risk to the upside and a lot of concern about increases in the commodities prices. So you might see an increasing level of skew to the upside, for example. Or you might see what is known traditionally as the smile type of skew, where the volatility increases no matter which way you go. If you go down or if you go up, the volatility increases. It's just an increasing volatility profile for a skew. So you see a lot of different types of volatility skews in commodities, and when you're trading options, they are going to be impacted by that, particularly if you're trading broader spreads that span the strike chains and the option chain. If you're doing risk reversals and verticals, like I mentioned before, and things like that, they're certainly going to be impacted by that. So be aware of that when you're going into products like this, and certainly research the skew you see in your particular product, because you may find it surprising and very different from what you're used to on the equity and index options side. All right, Alan mentioned a few product categories. Let's get into those, touch on those really quickly. Mike, one of the reasons I wanted to have you on the show today is you trade a lot of GLD. You trade a lot of gold. That's kind of your baby, one of the big things you trade. Of course, and the metals in general, the shiny stuff, is one of the primary drivers for a lot of advisors who are coming to this space and saying, I want to get exposure to gold, whether as a diversification tool, whether as a hedge against inflation, whatever the case may be, part of your 60-30-10 allocation, however you want to break it down. Gold is a primary driver for a lot of these guys. So they come to this side of the fence for the first time looking to get exposure to gold. And you can certainly use those strategies we just outlined, the verticals, the underlying replacement, the spreads with wings, all those things work in this context. The interesting thing about the metals, like I said, is that gold and silver are two of the futures products that have vibrant ETF components as well. And unlike a lot of these other ones, the ETF actually performs very well, and it actually tracks the underlying very well because they actually hold the physical. So this is one of the few categories where you could actually do well if you don't use the futures option. So I guess I'm starting it off with the exception that proves the rule. Mike, like I said, you trade a lot of GLD in the options, of course. What are some of your criteria for when you use GLD and the options on the GLD versus going into, let's say, the big metals futures? And when do you make that leap?
Well, typically with GLD and SLV, if it's gold or silver exposure, I'd say 99.9% of the time, I'm going to be using GLD or SLV. The only time I would consider going into the future side is if we were looking for something specific with which we would bring in a CTA or something along those lines. If clients need exposure to oil or or natural gas or something along those lines, then the key point that I'd like to make here is that I'm not a fan of USO or UNG. Just because of the fact that, and I've been a non-fan of them for many years. I don't even remember the full reason why I'm a non-fan of them exactly, but it came down to something that along the lines of which they're using the futures and they're rolling the futures, and there's no real way with which you can just buy physical natural gas and hold it like SLV and GLD do. So when a client needs exposure to oil or natural gas or something along those lines, typically what I like to do is either buy a stock that would correlate to something like that, or just go to the futures option side and trade that. The problem with trading the big gold contract is that it is exactly what it is. It's the big gold contract. Or I'm sorry, the big oil contract. I'm sorry, I misspoke. It's a very big contract. So for example, if oil is at $100 per barrel, let's say, I know it's not there right now, but let's just say in theory it was, then, and you go long one oil contract, futures contract, then you have $100,000 worth of exposure in oil. Now, yeah, of course, you do have the mini oil contract, which is half that size, but it makes it difficult if you're just trying to put in like maybe $10,000 to $20,000 worth of exposure for a client. You're going to need a bigger client if you're trying to match things the way with which you want to do it on there. So I like to use, I think GLD and SLV are very simple. You can have them in the same account that you have. You can have them in an IRA. You can have them in the same account right alongside of doing Apple, SPY, TLT, or whatever underlyings with which you're looking to do. But if we want to have exposure to the other commodities, I tend to shy away from the other ETFs, and I would prefer to use the big oil contract. We'd set up some type of an option strategy on it or something along those lines and use that Series 3.
Got to use it for something, right?
That's right.
You're right, Mike. There are many problems with some of the other product categories. That's why I started with the metals, because they're a little bit easier for people to typically wrap their heads around, and also because there are alternatives for them if they do want to dabble in, let's say, the GLD options waters first before they move on to the big futures options. Because at the end of the day, I call them the big futures options because they are useful primarily for that case where you want to get a lot of exposure. You want to bite off a lot of exposure to a particular underlying. GLD and others are much more useful if you want to just take a little nibbles at the underlying instead. And they certainly will function in that scenario. You mentioned USO, and indeed, crude oil and oil and energy in general right now are also very hot commodity sectors for a lot of advisors to look at. It's very much in the headlines right now with what's going on in the Middle East and what's going on in those products. We saw oil spike, we saw oil volatility spike, and then both of them have since pretty much come off the other side of that spike in a long, slow downward trajectory as supply has remained relatively steadfast despite those surprises going on over there in the Middle East, and also volatility has come off as a result of those disruptions not really coming to pass. So it is an interesting sector. Alan, when you're talking to advisors, throughout the country and indeed around the world, you mentioned some product categories earlier. What would you say is top of mind for a lot of the advisors who are looking for alternatives exposure and using options to do it? Would you say it is the metals? That seems to be the gateway drug for a lot of them. Is it maybe has oil usurped that now? Is something else coming into pass? Or what's your take on that?
The gateway drug, I love it.
I'll have to coin that as well. But yeah, I would have to say it's definitely the metals. That's the questions we get most about is how do we use options on precious metals and predominantly gold, not even silver for that matter. I would say gold is paramount. I mean, if you travel around the globe, you'll know that for many households, diversification is what you wear around your neck or on your wrist, and that's in the form of gold. So it's these people who understand historically that in times of crisis that gold is something very precious to hold are very curious about how to use options to hedge positions with natural gold. I would say that from an advisor's perspective, again, just like it is in the equity world, it's difficult to manage the kind of risk and taking on options positions and rolling strikes and doing that on a daily basis. So many of them will choose a sub-advisor that can do that for them and offer that to a client as a sub-account. So that's usually how we see advisors stick their toe into the water in terms of using options either on commodities or on equities or ETFs.
And you're right, oil, of course, and gold being top of mind, but there are other product categories that are interesting to a lot of advisors looking for exposure. I mentioned the ags at the top of the show, and the ags certainly have seen a lot of movement of late. Corn in particular having a pretty rough go of it. Supply is very robust. A lot of rain here in the Midwest, and that's been weighing down on corn prices as a result. Of course, also wheat and soybeans also have very vibrant, very robust, very deep and liquid markets from an options perspective. So if you're looking for products out there that you can trade from an options perspective, not get run over from a spread perspective, can get in and out of fairly easily, can utilize those strategies we talked about before, the verticals, the stock/underlying replacement, the spreads with wings, all the other fun stuff we talked about on the show many times. You can do those out there in those products as well. They won't run you over from a spread or execution perspective. And again, another area, like Mike mentioned with USO, the USO and the ag ETFs like corn and others, they all tend to fall short when it comes to replicating and tracking the underlying. They don't work. So that's one of the main problems with those. People pick up those ETFs as a way to gain exposure to those alternative asset classes, and yet, for whatever reason, they fall flat. Of course, speaking of ETFs and things that fail from tracking the underlying perspective, I think, you guys joked about my gateway drug term before, and the gold, certainly, GLD certainly doesn't work in that perspective. When it comes to futures options, though, it seems like the gateway drug has really been, for many of the retail out there, and a lot of advisors as well, has been the volatility products. Things like VIX has really opened a lot of people's eyes to this new asset class of volatility, and of course, the way you have to get into that is using the VIX, which is an option on a future. So a lot of people have been dragged, perhaps unwillingly, into the realm of futures options as a result of VIX. Of course, there are alternative products out there as well. There's things like VXX and TVIX and a legion of ETFs and ETPs, all based off of VIX in some way, shape, or form. All of them have a myriad of problems. Randy, if you're looking at the volatility space, I know you don't trade a lot of these on a regular basis, but you're, of course, very active in S&P options and, indeed, using a lot of those products. So you're very familiar with S&P implied vol as a result, which is, of course, what VIX is derived from. What is your take on essentially the state of all of these volatility products that have sprung up around VIX and effectively a lot of these ETFs, and whether they are indeed preferable to using something like the VIX options outright or the VIX futures outright, or if you definitely prefer to use the ETFs? Where do you fall on this, it seems like, increasingly dogmatic schism in the world of options and indeed volatility?
Well, I believe those options and the futures have a place in a portfolio. What we deal with at our firm is trying to take something that's much more complicated and trying to refine it down to something that's more simple and more easier to understand to our ultimate end client. So it's almost, to me, like a derivative on a derivative is harder to get in that contract. But fundamentally speaking, we like some strategies on that, but it's a very, very small percentage of our portfolio due to the difficulty in trying to explain how that works. Obviously, as you know, and we've talked about in many shows in the past, implicit in any option used is the volatility component of that. So beyond that, it's just not something that we use on a regular basis in our strategy.
Yeah, the nice thing about options, you're right, is that you can gain volatility exposure from pretty much using any option you want to use. They all have that implied volatility characteristic. So if you want volatility to be a part of your core holdings or an exposure or a hedging tool in your portfolio, any option will give you volatility exposure. If you want the quote-unquote pure volatility as an asset class type of thing, then those VIX products can certainly service, provided you understand all the caveats that go into a product like that it is indeed queued off the future, not the cash, which is the index, the value that is quoted most often on places like CNBC. So you have to understand the futures. You have to understand the term structure that goes into it. And, of course, a lot of these ETFs like VXX and TVIX and all these others have a lot of problems really dealing with that futures term structure as a result. They rebalance on a daily basis, so they're very much negatively impacted by that roll yield, essentially buying very expensive long-term volatility from the longer-term futures, selling cheaper near-term volatility, which is from the nearer end of that futures curve. And so as a result, they're losing money on a very regular basis doing that rebalancing. So bear that in mind if you're going to use volatility ETFs in your clients' portfolios. We much prefer here on this show using the more native product, using the VIX options and maybe some of the nearer term stuff like VXST if you want to get very short term, and using the spreads we talked about before, risk-limited spreads like verticals and things like that to gain exposure to these types of alternatives as opposed to just willy-nilly going out there and, let's say, loading up on a VXX. I think you're going to be very disappointed if you do that. So let's just, to wrap up here on our kind of intro to futures options for a lot of our financial advisors, futures aren't the scary beast you may have thought when you first thought about these products and got into them. So if you are interested in getting exposure to some of these alternative asset classes, futures can be a viable way to go, and futures options certainly are a viable way to go. You don't need to trade futures options. You'll need to have a futures account. You need to open up an account that can handle futures for all the underlying issues. But indeed, you don't need to trade futures to use them, particularly if you follow the strategies we outline here, which are very risk mitigated, things like spreads and others, where you're not going to have to worry about things, short legs and things like that getting assigned on you. And also, if you're pretty diligent about it, you close out your spreads, getting it to expiration and things like that. You don't have to worry about futures being assigned to you or having to exercise anything like that. You just trade the options like you normally would any other product. So they're definitely a viable way to go, particularly if you want some nearer term exposure in an account to something like a gold or an oil, and you want to use a futures options to do that. It's a great way to do that on behalf of your clients. All right, so really quickly here, we'll wrap up. Mike, the utilization of the utility of futures options versus, let's say, ETF or equity options for advisors, where do you fall? When do you use them? What are some of the caveats you want to leave some of our listeners with?
Well, I guess I'm stuck on the gateway drug in a lot of ways with gold and silver.
I blew your mind with that, didn't I?
Yeah, I'm stuck on the gateway drug in a lot of ways. So when I choose to start taking other drugs in other ways, maybe no. I've been in the options and futures business for over 10 years now, and I've traded commodity options, I've traded futures, I've traded the whole gamut. Most of the time, what satisfies my clients' needs for commodity exposure typically can be done with gold and silver. We've done things with oil. We've done things on the futures side in the past. At this point, we do not have any commodity exposure. So, well, I guess it's a good thing with what's been going on with oil lately. So where it stands, I like the gateway drugs of GLD and SLV. But if you are going to go to have some more diversified exposure, I think oil might be bottoming in some ways. We might be dusting off the old Series 3 and getting some of our clients into some futures accounts and getting some exposure along those lines. We're still a ways away from me even wanting to think about doing anything with oil, but that would be the next thing to do. Right now, it's just too slippery, pun intended.
All right, and Alan, like I said, you crisscross the country on a regular basis talking to these advisors. The primary focus for you guys at OIC has been on the equity and index realm. Would you say this is a growing category for you guys at OIC? You're going to be putting more effort into this going forward, more outreach on the futures option side of the fence as well?
I think we'll react, Mark, into what the demand is. We're not seeing it quite yet in terms of the futures, the options on futures in the commodity space. I think, as we've all stated here on the call, is that everyone has to start somewhere with a little bit of learning. And I think from our perspective, we have much more material on our website about options on equities, options on ETFs. Certainly gold and silver are in there and appropriate to use just as they are for any equity. So we'll play it by ear and see what the market demands.
And Randy, like we said, you primarily utilize the financial end of the futures and futures options spectrum. But as we're wrapping up here on the futures options tip, for new advisors, people who are thinking of perhaps dipping their feet in those waters, what are some things you'd like to leave them with as they're making that consideration and doing some of those first trades?
Well, I think you start off with the right amount of education, and then I think you start small and you get comfortable with the new products and the new processes and nomenclature of each, futures versus normal, traded options and stuff like that. I think that's probably my advice. Start small.
Sounds good, Randy. And that's going to do it for our Options 101 segment. Now we're going to keep on rolling right on into our Buzz segment.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, welcome to The Buzz. This is indeed the portion of the show where we break down some interesting developments in the world of options that you as an advisor may not be aware of, may not have time to follow, and all the interesting trends and news and developments we're seeing in the world of options. And Alan, one of the reasons I like having you guys from the OIC on the show is you always come armed with some great data. You guys are always out there commissioning studies on various aspects of the space, how strategies perform using options, and indeed studies on the very uses of options in the advisor's realm. And you guys do that great study every year looking at how advisors use options. You just completed the latest annual iteration of that study and had some interesting findings as a result. Why don't you tell our listeners some of the findings you guys found looking at the way advisors use options?
Well, actually, Mark, we do it about every 3 years or so. So the last time we did it was in calendar year 2011, and that was essentially the benchmark. You establish a benchmark, and then you go back using the same questions to see if the behavior has changed at all in that time period. And what we found is that the number of advisors using options has increased significantly from about roughly 48% in 2011 to 61% in 2014. And what will interest the listeners is that some of the biggest adherents or users of options are coming from books of business that are between 50 and 100 million. So while we always see a preponderance of folks that use options in the $500 million books of business, we're starting to see real growth in the smaller categories of assets under management, which I think speaks to the acceptance and the use of options as a asset tool within a portfolio.
Now, nearly 2/3 of advisors, you're saying, are utilizing options. I think a lot of people listening may say, wow, that's a very large percentage. That may surprise a lot of people that the penetration is that high. Did that number surprise you? And let's break that down a little bit. What does that actually utilize? What does that actually one more time? What does that actually mean for advisors? Are they out there writing calls, let's say, themselves and buying puts and doing all that fun stuff we talk about on the show on a regular basis? Are they perhaps buying structured products that do it for them? What does that actually mean?
Yeah, what it means is that they use an optionable strategy. So it encompasses all of that. It includes a structured product. It includes using an ETF that is an embedded options overlay strategy. It involves them using their wirehouse help desk to devise a particular strategy for a particular client, and it also involves the advisor themselves implementing a particular override strategy for his client base. So it encompasses everything under the sun in terms of options. So at the end of the day, you're never going to have full penetration of every advisor using options on a day-to-day basis because, quite frankly, he's too busy to manage the portfolio himself. So there are those that can and those who choose to say, okay, I get it, I understand it, my client has bought into the use of options. Let's find a method whereby we can get an exposure to a particular option strategy that he likes or he or she likes, and that is very easy to implement from an advisor's perspective.
And what were the primary use cases that you saw for options? I'm going to go out on a limb and say it's probably going to be hedging and income. Is that pretty much what you guys found in your study?
Yeah, that's pretty much it. We don't see a lot of speculation as you might imagine. So a lot of that is covered call, which is income generation, or protective put, or I would say the third choice would likely be something like a collar strategy, where it's both income generating and protection on the downside. Interesting enough, Mark, in the coming months we'll release the Notre Dame study, which is an entirely different study. It's looking at the 10 most commonly held individual equities in 401k accounts as described by CNBC in a poll 2 years ago, and then looking at a naked buy and hold of that security, looking at a covered call, looking at a protective put, looking at a collar, and then looking at a covered combination, which is the sale of both a covered call and the sale of a put as a double income strategy. And we have some of the results pending second iteration, but I'll keep your listeners tuning in for future broadcasts because we'll be prepared to release those results sometime before the end of the year, and I think it'll be very interesting for readers.
Yeah, that's interesting to me, of course, particularly the double income. I like to see that you guys are incorporating that again. I know you tried it in the past, and I think the notion of selling two contracts instead of one blew a lot of people's minds, but people are more receptive to those things these days, and I think it'd be interesting to see how that type of strategy performed versus some of the more traditional strategies like a collar and covered call and things like that. Speaking of perception of options, one of the reasons we hear from advisors that they resist embracing these products is because they're afraid of what their clients will say when they say, hey, we're using options to hedge your portfolio. They might go crazy, think they're adding risk to their portfolio. They might have an adverse reaction because, let's be frank, options still have a negative perception amongst the broad investing populace. So what did your study look at this, and what did advisors who use options, what did they say the impact was from their clients? Did the clients appreciate it? Did it help them grow their business? What was the net impact to them from a client perspective?
Well, let me address the first part of your question. From an advisor's perspective, they look at it as a diversification of their business model. So they're able to do something that their peers are unable to do. But I think surprising to us and to your listeners is that a lot of the demand for an option strategy is client-driven and not advisor-driven. So clients are actually coming to advisors and say, hey, you know, I was listening to a program about options. Can you explain this more deeply to me? And this sounds like something I might want to implement on a certain part of my portfolio. So that is something I think is a trend that's been going along for a while now, and something that we will continue to see because, quite frankly, there's so much information about options out there on the web, through conferences, through OIC, and through the broker-dealers themselves that all have educational arms.
That's amazing to me to hear that so much of it is client-driven because, as we've heard many times on this show, talking to a variety of different advisors and just out there anecdotally in the field talking to them as well, one of the main reasons they always cite is my clients don't want it. They're terrified of it. I'm afraid to terrify my clients. So the fact that you have hard data out there showing that clients are the ones driving this demand, I think that will open the eyes to a lot of advisors who may have been reticent in the past that, hey, this is something I can do and I won't lose clients. I will actually gain clients perhaps as a result.
I think, Mark, that a lot of it is driven by the fact that we're in such a low interest rate environment and have been for quite a while now. I know, contrary to what people believed at the beginning of the year, they thought we'd see a big spike in interest rates and even inflation, and that didn't come about. So you have a need out there because fixed income is not returning what it has historically, that people need income in their portfolio. You've seen a big movement in underlying security prices over the last few years, and certainly that also begs to having an option strategy that protects those gains. So those two factors are probably preeminent when it comes to clients looking for an option strategy.
All right, and Randy, you've clearly been around the advisor game for quite a while. You speak with a lot of advisors. You speak at a lot of events. You've seen a lot of this space and how these options uses have unfolded over time. Do these results surprise you at all? What's your take on this, the fact that close to 2/3 of advisors are using some sort of options-related strategy and all the other statistics we've mentioned about client-driven demand and things like that? Does this surprise you, or is this pretty much what you expected?
Well, I think the absolute level of advisors using options surprised me a little, but not the rate of change. Of course, I usually get people into our strategy when the advisor has already made a decision or close to making a decision to use a firm like ours. So we don't get to see the people that are not, very often when they're not interested in actually using an option strategy. But generally speaking, I think the word has gotten out, and it's been a long battle. But, I just look at the growth and the assets that we're managing over the last several years, and, we've gone from about $100 million to about $1.6 billion just in the last 2 or so years. So, it's a compelling story as what I spend my life, talking about on a daily basis. So generally speaking, the types of strategies that Alan mentioned are consistent with my use and our use and the demands that other advisors want to find managers that do strategies like what we do. I definitely have not found a lot of money managers that are offering speculative strategies for most typical, advisors. It's really much more in the wealth preservation category and alternative space.
That's right. You guys are, I think for a lot of advisors, by the time they get to you, they've already drunk the Kool-Aid, if you will. They're ready for a sub-advisor. They're ready for overlays. They've made that decision to embrace options. So you're not perhaps interacting with them when they're still on that precipice of, should I do this? Should I not? Or will my clients embrace it? They've already dealt with that and made the decision that the answer is clearly in their instances, at least, yes. But maybe if these numbers hold true as we see them in the marketplace as they unfold over time, sounds like a lot more advisors are going to be making that decision and probably beating a path to your door to say, hey, I want to talk about things like overlays and tail risk and all the fun stuff you guys do over there at Swan on a regular basis.
Well, we always like the concept of the pool of money managers doing strategies like ours gets bigger. It seems sometimes counterintuitive, but it's kind of like the analogy of the fast food chain. When you have, maybe a dozen fast food chains in a certain area, you get more business for all of them, and that's the way we look at it. The educational aspects of what the OIC has done, as well as us speaking at many conferences and other advisors and managers speaking at their conference, really has gained traction at this point. And so we look forward to continuing our strategy and offering new products. And we'll get into this a little later, but we're in the process of launching a new international equity version of the defined risk strategy that we expect to launch by the end of the year. And it's just continuing along that same philosophy of, we look at the strategy that we run is a strategy that we can place in whatever underlying product there is, provided there's liquidity in not only the underlying but the actual options market. And of course, the goal, we think, of every advisor should be combining different money managers that are non-correlated and offer the types of returns that fit with the client's perspective on risk and return, what they want in their portfolio.
You're right. It is a terrible cliche, but in this scenario, it actually applies, and that is the rising tide lifts all boats. If more advisors embrace options, they utilize them, the clients understand them and demand them from the advisors, it is going to drive more business to everyone in the space, including guys like you, including the guys at OIC, including us at Options Insider. It lifts all boats, really, so it is a good thing at the end of the day to see these numbers growing, see more advisors implementing these strategies, as well as just it's a good thing for the economy as a whole to have more people who are managing these funds actually being able to risk mitigate in a much more active degree than just riding up with the market and then riding back down like we saw in 2008 and 2009 to very disastrous consequences. All right, that's going to do it for our Buzz segment. It's also going to do it for this episode of The Advisor's Option. But before we go, as always, let me check in with each of my cohorts here on the Old Advisor's Option panel to see what they have cooking that may interest you. Mike, we'll start with you since you joined us late. You get pride of place. You're our guest today. What's cooking over there in the land of RCM Wealth Advisors?
All right, so in December on the 10th, we have a big event coming up in Miami. For more information on that, check out rcmfutures.com or feel free to contact us. All of our information is on our website. Thanks for having me today, Mark.
All right, thanks for that, Mike. Always good to have you on the program. And Alan, you teased it a little bit, but the Notre Dame study, but you can maybe mention a little bit more about that, as well as what else is cooking over there in the land of OIC Advisor.
We have an advanced seminar this evening in Arlington, Virginia, And that's going to be on the vertical spreads, the butterflies and the condors, which you mentioned earlier in the program. We'll also have a Trading and Understanding Risk Seminar out in Los Angeles this evening, so if you're out in the LA area. And then we'll have an Options Education Day event in Toronto, Ontario on September 27th. And for me, I'll be doing a class on rolling option positions. That will be October 11th out in Schaumburg. It's an investor education day, so I'll look forward to seeing anybody out there who's in the Chicagoland area.
Well, it's a busy night for OIC education, it sounds like, across the country. Unfortunately, this show won't go out in time for people to take advantage of those classes, but they can, of course, go see Alan and Eric and all the other fun events that you guys do, and as well as Joe and the rest of the team there, doing a lot of great outreach and education on behalf of options. And last but certainly not least, Randy, you just touched on it. Give us a little bit more information about what you're cooking over there in the land of Swan Wealth Advisors and some of the new additions you may be making to the family over there of products and asset classes and funds.
Well, right now, like I said, we've already signed on the dotted line and filed something with the SEC to launch our new international equity version of the DRS. We are going to try to take it the same concept to some type of gold product early next spring. We're trying to work out the actual wrapper that we can place that in because we're having problems with that qualifying under the 40 Act, but that's something that we will probably be coming next spring. In terms of speaking engagements, I am going to be speaking at the Hoyle Cohen annual conference out at Torrey Pines in La Jolla in early November. Anyone interested in attending that should look at our website and find the dates or contact me directly if you want to participate in that conference.
And that website he mentioned, listeners, is swanwealthadvisors.com. You can surf over there, click about all the different research they have up there, see the events they have coming up, as well as learning more about the things they do over there, like to define risk strategy and some of the new things they have coming up that Randy just mentioned. And on behalf of Randy and Alan and Eric and, of course, myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show. And we'll see you next time right here on The Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.